Hey, everybody.
We are
Want
recording.
to thank you all for joining. This is it's an honor to have the opportunity to introduce Scott Forehand, who's actually been a mentor for me for Debt Free Life. He started offering his time on Thursdays to help us all not only get a better understanding of different ways we can use this to help our clients, but also as an opportunity to get our clients to hear from someone who's been doing quite a few of these and getting great results, and have them learn from him directly how this can work. Just a little bit of background on Scott. Scott's been with us coming up on 2 years now, Scott, or are we at the 2 year mark? Nope. Okay,
Not
coming up
quite
on
2
2
years.
years. Not quite 2 years. He's an agency owner down in the Virginia Beach area. Prior to that, Air Force, if I'm not mistaken, right, Scott? Okay. And to put it in perspective, he's in last year, just to put things in perspective, last year from a mortgage protection perspective, he helped nearly 500 families get mortgage protection, and since starting Debt Free Life, he's helped over 50 families. These are a little bit more complicated than mortgage protection, and the results are kind of amazing when these plans are fully executed. He will have saved his families over $30 million, and it will have added about $90 million towards their retirement. So this is something I believe very strongly in. And without any further ado, just want to introduce Scott, and thank you very much for your time.
Thank you very much, Tom. And thank you, George Matthews, because if it wasn't for you, I wouldn't be here. So thank you very much for bringing me into this business and being my coach and my trainer and my mentor. I will never be able to thank you enough. Anyway, just thank you very much for that kind introduction, Tom. Just want to give you guys a little bit more numbers. What I've done is kind of inconsequential compared to what Symmetry's done on a national level. And these numbers are as of the end of last month, as of the end of May. And these numbers come directly from Logan Long at corporate. So far to date, Symmetry agents, since we started this program in June of 2019, so we haven't even completed one full year yet, we've eliminated $755 million of debt as a team here at Symmetry. We've eliminated $243 million of interest, and we've created $1.995 billion of retirement. So that's just what a few Symmetry agents have been able to do in a year. And that's what the kind of impact this is having on folks that are our clients, our friends, our families, and anybody else who will stop long enough to listen to what a DFL plan can do for them. So, so anyway, without further ado, again, my name is Scott Forehand. I'm here to talk about Debt Free Life, explain what it is, and in the parlance of Symmetry Financial Group, I am direct to George Matthews, King George up there on blue shirt. So George, thank you again. So what is Debt Free Life? Hold on one second. Let's get this party started. So Debt Free Life is a proprietary product offering from Symmetry Financial Group. It is a solution that it is not a new concept. It's been around for a while. It's just most of the iterations before today, before we offered it last year, were either incomplete, fallible, or overly expensive to the point where most of the general population wasn't eligible to be able to try to execute one of these plans. And the reason why you're here today is because you're either an agent trying to learn more about this, you were sent here by one of your underwriter brokers because this is something that might be appropriate for you, or potentially you're one of my clients. So again, welcome. So the words Debt Free Life is actually a play on words, and it's really what we're trying to do here is we're trying to get you out of debt by using a life insurance policy, a very specific kind of life insurance policy. And in the process of utilizing this very specific kind of life insurance policy with a couple of very specific riders, we're actually going to create an environment where we're going to defeat that debt monster that we're using these days, and we're going to provide a safe, secure, and tax-exempt retirement plan in the process. So these are two questions that we're taught to ask when we're learning about this program and how the program works and what it can do for people. And the first one's pretty simple. Are you 100% sure that you're going to have a great retirement? And I don't know, I haven't met anybody yet who says yes to that question. Especially if you're in the 401k, 403 TSP arena, then you've seen your retirement dwindle over the last couple of months, and you should have some serious doubts about the security of your retirement plan. The other question we typically ask is if we can show you a way to get out of debt in 7 to 9 years, or in this case 9 years or less, without you spending any more money, would you want to hear about it? And so that's what we're here today to talk about. Those are those two key things that we're going to do here. So without further ado, one comment I want to make about that 9 years or less comment there. The reality is it actually works. It's not that it's 9 years or less. It cuts a number of years off your plan. So I've seen these. I've done plans for about 60 families at this point, and what we're looking at in general, it's not that it's 9 years or less, although most of the time it does fall in that range. But what it's really doing is it's cutting somewhere between 15 and 27 years off your horizon to become debt free. And when we harness that elimination of debt and using those funds over and over and over again, then what we're doing is we're creating a massive tax-free retirement in the long run, which is what this thing is designed to do. So if you're like me, you're the average American before you heard about debt-free life. You save about 3% of your money for your retirement. You spend about 34%, whether you want to or not, on interest. You spend about 40% of your money, whether you want to or not, on taxes. And the rest, that little sliver, that 23%, is what you live on. That's what you're paying your mortgage with. That's what you're putting food on the table with. That's what you're paying your power bill with. That's what you're putting gas in your car with. And moreover, that's what you're using. Whatever's left is what you're using for entertainment. And I would posit that this is absolutely not the American dream. This is not the way it was supposed to be. We weren't supposed to be paying this much in taxes. We certainly weren't supposed to be paying this much in interest. So this is not what the forefathers of our country had in mind. And it's like any kind of project, if you will, every project has some what we call scope creep, and that's exactly what's happened here. We've gotten further and further away from the ideal. So when you are looking at what you're doing right now, overpaying the interest, overpaying the taxes, not having enough money for your lifestyle, and really under saving what you need, then this is a program that will definitely, absolutely, positively, without a doubt, work for you as long as you're currently able to make your debt service. If you've got $2,000 a month in debt and you're paying $2,000 a month on those debts, great, you're in good shape. If you've got $2,000 a month of debt payments and you're only paying $1,800, this program will probably not work for you very well. Moving on. So this is the average American. The average American makes plenty of money. We make about $2 million in our lifetime. That is plenty of money. And that's whether you're working as a dishwasher, paperboy, waitress, or if you're got a college degree working as a teacher, average blue collar workers, that's what you make in a lifetime typically, or more, depending on where you live in the country. The problem with that scenario is that we don't have enough money at retirement. And why is that? And that's part of that is because we are taught from a very early age that it's okay to take on debt. And when we're taking on the debt, we are essentially trading our future for whatever that widget is that we want now, that new car, that new sofa, that new TV, whatever it is. So what we do here is we change the way we're spending money. I'm not saying you're never going to get a new car again. That's not what we're saying. And I'm not saying you're not going to be able to furnish a new house. That's not what I'm saying either. But what I am saying is we're going to show you a better way to spend your money. We're going to show you a way that you can save appropriately and make those dollars work for you in a more efficient manner. Before I found debt-free life, this absolutely was me. And now that my family's doing debt-free life on us, we're going to be out of debt in 3.6 years. That's the house, the cars, the credit cards, everything gone. 3.6 years. Was 6.6, but we do some tricks, and I'll show you those a little bit later. So the traditional approach to getting out of debt, if you go talk to a credit counselor or a debt consolidator, they're going to say, go work harder, spend less money, go eat ramen, stop going out to eat at home, refinance your debt, consolidate your debt. And in some cases, they're going to tell you to snowball your debt. Of all those things there, of all those potentials that will get you out of debt, the only one we really focus on is actually the debt snowball. And we only focus on true debt snowball. So what's the difference? Some people call debt snowballing paying off your highest interest thing first. And then as soon as that thing's paid off, use the money that you were spending to pay off the next highest interest thing next. That's not debt snowballing, that's debt stacking. And there's some other solutions that have been out there that I mentioned earlier. There's other plans that have come before this. This is not new. It's just ours works better because we've taken all the guesswork out and we've eliminated the reasons why those other plans fail. And one of those reasons why those other plans fail, or at least they're not as efficient as ours, is because they don't do true debt snowballing. Our system does. True debt snowballing says there is one absolute best way, one absolute fastest way to get out of debt. And there is a very specific order in which your debts are going to get paid off based on how much you owe, what the interest rate is, and what the minimum payments are. And so there's actually 3 variables that determine how quickly you're going to get out of debt. And with our software, we're able to, without a doubt, compute the exact route that you need to take. And that's one of the key things that differs this system from some of the lesser systems that are out there. So our better way, we eliminate debt in 9 years or less. Nope, we'll eliminate debt in 15 to 27 years earlier than what you've seen. The potential for this solution beyond just the debt elimination, though, is a truly tax-free retirement, which sometimes that's all we're looking at. Sometimes we have people that don't have any debt. They're just looking for a better way to save or grow retirement. And this is a perfect vehicle because it's hands-off and it doesn't matter what the market does. We are completely insulated from market volatility. So when we compare the system that you're accustomed to, which is on the left, the average American household with $250,000 worth of debt, and the methods that we would normally associate with that, how to get out of debt, we're not really changing the interest rate over time. We're not changing the taxes. Actually, in some of those other scenarios that are out there that use these types of thought processes, they actually increase the amount of taxes you're going to pay over time. And where we are on the right side of your screen, this is what we're going to do. We're going to decrease the amount of taxes you're going to pay by what, if you do the math there, it's 10%, but that's actually 25%. We're going to increase the amount of money you have for your lifestyle by 43%. We're going to eliminate taxes to the tune of about 35%. And the most shocking number here, and I'm going to say it, and it's true, is we're going to increase the amount of money you have for your retirement by 500%. Doesn't look like a lot on this screen because it's only going from 3 to 15, but that's a 500% increase. So if you go back earlier and we talk about the average American only having $60,000 at the end of their run for retirement, and they're reliant on their pension if they've got one, or God forbid, Social Security, having $300,000 is a much better position, especially considering the kind of return you're going to get on a $300,000 lump sum, whether it's a return in the form of your interest or a dividend or something like that. It's going to be, it may or may not be enough to live on, but it's going to put you in a lot better position than you would be otherwise. Moving on. So this is our goal for you. We want to get you to that 15% mark where we're saving 15% of your income over time, where we're decreasing the amount of interest you're going to pay over time. We're decreasing the amount of taxes you're going to pay over time. And we're increasing the amount of money you have for lifestyle. If we can do this for you without you spending any more money, that's probably why you're still on this call right now. That's probably why you're still here. And I can promise you, it does work. And it will work. All you have to do is listen to the person that got you here, follow the plan that they're going to create for you. And when things change, and they will change, life happens. You need a new roof, that was unexpected. You need a new car, that might have been unexpected. You know, when you're needing to pull money from this plan, if it's a need, then that's great. Do it, pull it. But you don't have an emergency need for a new jet ski. and you don't have an emergency need to take that trip to Tahiti, right? So make sure that you're spending the money on needs. And then this is creating a private bank. I haven't said that word yet, but I'll say it now. This is creating a private bank. So you're the banker. So when you lend yourself the money, pay yourself back. It's that simple. All right, let's move on. So one of the other things that sets our system apart from what everybody else does is the fact that we plan for the unexpected. And when we execute these plans and show you these illustrations, the one thing that's absent is there's a 20% nest egg that you're not going to see. The money's there. It's always there. It's growing. And it's getting applied an interest rate and a dividend as it grows, but you're not going to see it. And that's because we don't want you to tap into that unless it's a true emergency, right? And I just talked about some of the things that are not true emergencies. So by tapping into it, one of the nasty things that you'll be doing is limiting your long-term interest, your long-term growth. So we don't want you to do that. We don't want that to affect the plan over time. We want to make sure that we keep your plan in force. And if you need the money, take it out as a loan first. Don't touch the principal. Leave the principal, let it roll forever. That's your family legacy if you need it. So that 20%, like I said, we use the 80-20 rule. About 80% of the funds that you initially contribute to this are going to go to a place where you're going to have long-term growth. And there's going to be that 20% emergency fund that you're not going to see that's going to be hidden in one of the core parts of the plan, which we'll talk about in just a minute. So how does this compare to other types of, if we're looking at just in terms of a retirement solution, how does this compare to other things like a Roth or a standard IRA, standard 401k, 403b, standard TSP, those kinds of things? And invariably, whether you're in a tax-deferred or a tax-advantaged solution, they're not going to work as well as a tax-exempt solution. There's no way. They can't. So, and here's some examples here for you. So that tax-deferred solution there in the middle, that 49,000 mark, what that represents a standard IRA. That's what most people have as a 401k from their company. So if you take that same $10,000 investment, put it in this vehicle and pay the taxes on it up front, or put it in that IRA where you've deferred the taxes over time, when it grows over, as this scenario shows here, 28 years, assuming a 7% interest, assuming a 25% tax rate when you pull the money out, that money that you owed, that you have deferred, it has grown too. So that's why those numbers are so much smaller. You've grown the tax obligation along with your nest egg. And in the end, paying the money up front is a much smarter way to do it. Let me ask you this. If you think that the taxes in this country are going to go down, I would love for you to express that. I haven't met anybody who thinks that the taxes are going to go down. And if you've thought about this, if you think that the Social Security debacle that we're getting ready to go through, where they're going to have to rescue Social Security because they've been stealing from it for 30 years, if you think that they're going to let it fail, then I would also like to hear from you, because I disagree. They're not going to be able to let it fail. There's too many people that are going to be relying upon Social Security. So what are they going to do? They're going to rescue it. How are they going to rescue it? Well, luckily I'm over 50. So thank you for all the young people that are out there. You guys are going to get to pay more taxes over time to rescue Social Security so that I can have Social Security. Thank you very much. And that's true for all of us. If you're going to be collecting Social Security at any point in your lifetime, really all of us, but everybody's taxes are going to go up. There's no other way they can do anything to rescue it other than the two plans they're talking about, which is, one, they're going to make everybody retire later, and two, they're going to make everybody's taxes go up. So that's what we're all in store for. And oh, by the way, if you live in this country and you just received some kind of stimulus check, you know that they just added on another $2.2 trillion worth of debt. Where's that money coming from? Taxes are going up. And oh, they're talking about another stimulus package, another 3.3 trillion. Where's that money coming from? Taxes are going up. So if you have the opportunity to pay in tax now and have your nest egg grow in a tax exempt manner versus stop paying the taxes because later on you might be at a lower tax bracket. Okay, yeah, you might be at a lower tax bracket after you're not earning, but you're not going to be at a lower tax rate. And I will bet money for anybody on that one. So if you think for a second that taxes aren't going up, you need to reevaluate. Moving on. So debt-free life works in 3 phases, all right? Maximization, accumulation, distribution. And maximization, that is the initial part where most of us are right now. We all have debts. So the way that we maximize our long-term plan is by eliminating those debts in as fast a manner as possible. How do we do it? Debt snowballing plus infinite banking. 2 concepts been around for a long time. As far as I can tell, and I've done a lot of research on this, we are the first one that actually really maximize the benefits of both of those types of concepts, the infinite banking concept, as well as the debt-free, the debt snowball methodology. So in the maximization phase, this is where our software comes in. We're gonna work out a plan based on the information that you provide. What kind of debts do you have? How much do you owe? What's the interest rate? What's the minimum payment? How much is your maximum payment? What's the target payment? How much are you overpaying? Those kinds of things. We're going to find money there, and we're going to we're going to show you a path to spend that money in a more efficient manner so that we pay off all your debts, not some of them, all of them. This is not debt negotiation. We're not going to call your creditors and say, hey, we owe $3,000. If I give you $1,000 right now, you're going to write it off. And we're not going to tell you, stop paying everything, let your credit tank, and then come back to them and say, I know I owe you $1,000, I'll give you $300 if you write it off. We're not going to do that. We're not going to destroy your credit. Actually, what's going to happen is the exact opposite. Your credit's going to shoot up into the 800s after you execute one of these plans. But the beauty of it is, at that point, with the snowball started, you're going to be your own banker. You're not going to need to go to the bank to borrow money anymore. You're just going to take a loan from yourself, pay yourself back. Your credit, and the creditors that are out there will be falling over themselves to try to give you some credit. So moving on, assuming we're out of the maximization phase, we've eliminated our debt. Now we're in the accumulation phase. That lasts as long as you want it to last. You have to make sure you talk with your broker underwriter because it has to be structured correctly. But the point is we're going to maximize that debt by eliminating it. We're going to eliminate the debt, maximize your plan. Then we're going to go into the accumulation phase. Accumulation means we're building. And then we're using the money to build. And then we're using the dividend to build. And then we're using the interest rate, the compound interest to build. So we're building for as long a period of time as you want. This is where that question that you're going to be asked of where's your retirement horizon? Do you want to retire at 65? Do you want to retire at 67? Do you want to retire at 50? I don't know. This is where you're going to tell us that information. And the broker underwriters here should be able to go through our software and our plan and execute a plan where you're no longer going to have to pay a premium at a certain point. And then we'll be able to tell you, assuming a 0% dividend return, how much money you're going to have at the end. We'll show that in just a few minutes. And once we reach the distribution phase, that means we're no longer contributing to the plan. And the plan is on automatic at that point. And we can tell you exactly how much money you can pull out every year without affecting the growth. Or you can take more than that, which will obviously affect the growth. Or you can take none and let the thing grow at a hyperspeed. Okay, it's up to you. You have complete control. The nice thing about this plan, the way it works, IRS cannot tell you when you have to take it, like age 72 with an IRA. The IRS cannot tell you that you can't take it because you're too young, like someone who's 55 and still working. So the IRS has absolutely no control over this particular solution, and that's the way it was designed. It was designed to be insulated from IRS intrusion and IRS control. It was designed to be insulated from torts, so you can't be sued and be forced to liquidate this or use money from this to pay any kind of a debt from a lawsuit. Moving on. This, as I mentioned, is not new. This has been around for a while. There's 4 people on there that you see up on your screen that have done this. Walt Disney, Doris Christopher, Ray Kroc, Warren Buffett. Walt Disney did this with both parks. Doris Christopher did this when she started Pampered Chef. Ray Kroc did this for a number of the original McDonald's units that he used and bought and started. And Warren Buffett does it to this day. And I'm a big fan of Warren Buffett. And what he does, it works. And he does this, and it works without a doubt. They may have been called different things when they did them. And you'll notice a common thread here. All those people are super wealthy. So previously, when you would try to execute these plans, the carriers would have to create a specialized version of this for you, and you had to have a significant amount of money that you were going to dump into it so that the carrier would agree to essentially pay you more return with the guaranteed interest in a dividend than they were going to charge you on the loans that you would pull from this. That's why this thing works, and that's why it flies. So what Symmetry did and what Symmetry's done is we've created this solution so that anybody can have it at this point, as long as you're insurable, really. As long as you got a pulse and you haven't been told you're going to die next week, next month, or next year, you're probably eligible for this. And if not, there's other ways that we can do this. We can target other family members as the principal insured and still make you the owner, so you don't lose anything. So how does this work? I already mentioned the first thing. We're going to redirect, or in this case, we're going to spend money more efficiently. We're going to grow a cash value. We've already talked about that. We're going to grow it in a tax-exempt manner. No penalties from tax. No issues taking out the money too soon. No like 20% if you like your IRA. If you got money in your IRA and you're not eligible to take it, you need to take it out right now. There's going to be not right this minute because they lifted it, but normally there would be a 20% penalty for taking it out too early. Pay off your debt in 9 years or less. No, we're going to pay your debt off in 15 to 27 years early. How much is that? Maybe most of the time it is under 9 years. All right. The plan is going to get repaid via a couple of different methods. It can be repaid automatically with a dividend. The dividend reinvestments, like there's a thing called a DRIP in investment parlance, where it's called a dividend reinvestment plan. This is kind of like a DRIP, where the dividends come back in and it either reinvests into your plan by buying more room in your bank, or by paying down any loans that you already have against your bank. And we're going to use this for future purposes. Which ones? I don't know. Maybe it's the car. Maybe it's the roof. Maybe you drop a transmission. Maybe it is that trip to Tahiti. I don't know. But it's your money and you get to do with it. And you just need to make sure that you're a good steward of your money. You're the banker. And this is the last thing, is something I really, really like. This is about leaving a legacy. As insurance agents and brokers, one of the things that we're looking at is a lot of times is making sure that the family's protected or the family's covered when we leave. These plans, if they're structured correctly, it really can create generational wealth beyond just your kids and your grandkids. And if you can, I call it daisy chaining, when you have one, and then as soon as that person gets close to death, like grandpa, we took one of these out on grandpa and there's $500,000 in here. We're going to take $400,000 out, and we're going to put that $400,000, we're going to gift it to one of our grandkids, start one on the grandkids. So now we've made that $400,000 work for these 2 or 3 generations, and now we're making it work for the next 2 or 3 generations. So that's called daisy chaining. And so, like, again, if you structure these things correctly, you can do stuff like that. You can make your family in the future have your family be talked about because they're old money, right? Pretty cool. All right. So we've been doing this for a little while, like I said, about a year, and I read those numbers off at the beginning of this conversation. And these are just some of the families we looked at: $73,000 of the debt, $84,000, $100,000 worth of debt saved. Those are actually kind of small numbers with what I'm seeing. The smallest amount of debt that I've seen written off with, or not written off, but eliminated with this program is about $93,000 so far. Most of the time, the families that we run into, traditional blue collar families with a $200,000 mortgage and a couple of cars and a couple of credit cards, you're really looking at somewhere close to 300 to 350. And then the sky's the limit when you start throwing in student loans. So as I mentioned earlier, these are the things that we're going to do: save money, improve cash flow, reduce taxes, reduce interest, and provide, that says allow you to retire with a tax favored income. It's the most favorable type of tax income, which is a tax-free income. So moving forward, let's talk about how you currently spend money. So currently, the way you spend money is you make the money for your salary, your hourly wage, whatever. The money gets deposited into your bank, whoever you bank with, Wells Fargo, Citibank, Navy Federal, whatever. That money sits in there. It's your money, but what's happening with your money? The bank is making money with your money over and over and over and over again. The average dollar that you deposit into your bank account gets used by that bank and lent out by that bank 7 times before you ever use it. So, and the bank thanks you by saying what? Yeah, you've got enough money in your account that we're not going to charge you for this bank account. Really? That's what they do, right? So is that right? Whatever, they're figuring it out now. Of course it's not right. So, and do they pay you anything? Do they pay you any of that money that they're taking, that they're making with your money? Maybe. You might have a money market account attached to it that might make 1% or something like that, but they're making a lot more than that. I mean, they're making anywhere from 1 to 24% with your dollar every night, right? Because they lend it out. So in the end, it comes time to pay your bill. You pay your car payment, you pay your power bill, you pay your mortgage, whatever. You have to pay your debt. And what do? You either write a check or you go into your online bill pay system and you tell your bank to go ahead and pay your debt. So in the process of doing that, of paying your debt, what's happening? Your money has gone through your bank and become their money. And where's your money at this point? Well, your money's gone. The debt's paid, whatever it was, but it's now their money. And I say this all the time. It's kind of funny, but if you're really, really nice and really, really sweet, and you ask whoever has your money now for the money back, are they going to give it to you? No, that money's gone forever. So this is your current method. You are using your dollar one time. The bank is using your dollar many, many times. And in the end, all you're doing, the only result of this is that your debt gets paid and you've got nothing left to show for it. If you're paying your house, then you have a little bit of equity, but that's about it. So let me show you the debt-free life method. This is a better way. I think so. No, I know so. So in the same process that you're using right now, you make your money. You work your job, you get paid your hourly wage, you get paid your salary, whatever, doesn't matter. You make the money and you still take that income and deposit it into your checking account, whether it's your Wells Fargo or Citibank or whoever you bank with. Here's where we change. Instead of leaving that money in the bank for the bank to use over and over and over again, we're going to transfer your money in the form of making a life insurance premium payment. So we're going to pay that life insurance bill. Okay. So what does that mean? Maybe it's $150 a month. Maybe it's $500. Maybe it's $1,000. I don't know. Okay. It just depends on how you structure your plan and what you're trying to do with it. But you're going to make that life insurance payment. And when you do that, as soon as you make that payment, what happens? You've moved your money away from the bank. So the bank isn't making money with your money anymore. What did you just do? You paid for your whole life policy, because these things are based on whole life policies. Why whole life? Because whole life pays, they're permanent. They grow cash value over time. In some cases grow fast. And there's some other, which you'll see in just a second, there's some other very interesting riders we can attach to this whole life plan that makes this whole life plan fly. So you make your payment, you make your money, goes into your bank, goes into your checking account, you write your check, pay your life insurance premium. You've just moved your life insurance premium up into the top section there, into your whole life policy. But what else did you do? That whole life plan has 2 additional riders. It has a term life rider and a paid up addition rider. So let's explain what these are here for. IRS tax code 7702 says any monies derived from a life insurance policy are tax exempt, as long as it's a life insurance policy. IRS tax code 7702 also says if that life insurance policy has more cash value than the life insurance value, that it's not life insurance. At that point, it's called what we call a modified endowment contract, and then the whole thing is taxable. Game's over, you lose, right? So what we do is we attach a term life rider because it's cheap and because we can get a lot of coverage for term life. And what that term life rider does, it acts as an umbrella. So what it does, you take out your whole life policy, you make your premium payment, some of that premium payment goes to pay your term life rider, and then boom, you just opened the umbrella. And the umbrella says, hey, IRS, you can't see through me. Yes, I've got cash in here, but my life insurance is bigger. So when you've got a larger life insurance policy than the cash value, then IRS says it's tax exempt. It's all tax exempt. You pull money out, it's tax exempt. That's what we have to maintain. And we have to maintain that for a period of time, at least 7 years, so that we can get beyond the point where the IRS does those calculations and we worry about these things becoming a modified endowment contract. That last thing that you see there is called a paid up addition. What is that? Well, that's a gold bar. Every time you make a payment into your life insurance policy, the majority of your premium payment is buying a gold bar. So what is that really? That paid up addition? It's just life insurance, but it's fully paid up life insurance, which means it has permanent value and you never have to pay for it again. So if you look at the largest banks in the country, Wells Fargo, JP Morgan Chase, Citibank, these folks have their assets structured, majority of them structured in safe assets. They have 4 tiers of assets: tier 1, 2, 3, 4. Tier 1's the safest asset. Tier 4 is the most volatile, most risky asset. So here's an example. What's a tier 4 asset? A tier 4 asset would be a loan to a 20-year-old to go open a $5 million restaurant. Is that 20-year-old going to be successful? No. I would bet no. 95% of all restaurants fail in the first 5 years, and a 20-year-old, probably not. Nothing saying about 20-year-olds. Just saying they don't have the experience, the expertise, right? So that's a very risky asset. So banks don't do a lot of those. They don't have a lot of those assets because they have to protect their wealth. Where is the majority of their assets? 48 to 50% of all assets are structured in tier 1 investments, specifically, you got it, life insurance. So you've heard of viatical settlement companies maybe, or maybe you've seen the ads on TVs where there's these companies that'll go out, if you've got $100,000 or more in your life insurance policy, before you let it expire, call us. It's probably worth something and we'll pay you for it. What are they doing? They're paying for your life insurance policy, and they're going to take over payments on it. And they're going to give you maybe 10 cents on the dollar, if you're lucky, of what it's worth. So why? Because especially in the form of a paid up asset, it has permanent value. So you buy $1,000 of paid up assets. How much is it worth today? $1,000. How much is it worth tomorrow? $1,000. How much is it worth 30 years from now? $1,000. So why is that a better investment than a gold bar? How much is that gold bar worth tomorrow? I don't know. How much is it worth 10 years from now? I don't know. Is it going to go up? Maybe. Is it going to go down? Maybe. Right? So the risk is there, and the risk is unknown. It's uncertain. So why life insurance? Why specifically paid up life insurance? Because it's a permanent asset that will never lose value, that you do not have to pay any money to maintain. So what do we do here? We have moved money from our checking account into our whole life policy with those 2 riders, and we have moved the cycle where the bank gets to make money with our money over and over and over again, to where we get to make money with our money over and over and over again. We've created our own debt-free life bank. That's a DFL bank. So how does it make money over and over again? Well, because the value of your paid up additions plus the cash value of your whole life, whatever that number is, you're getting a guaranteed interest rate, compounded in many cases monthly. And then you're also getting a dividend paid on that at the end of the year. That's how we make money. The guaranteed interest rate is about 4%. The dividend, I've seen it as high as 8. Can't tell you, depends on the carrier, depends on the year, right? But in this case, you're the one who's making the money with your money over and over and over again. One more thing I want you to think about. When you make that payment up into that whole life policy, and you never, remember earlier I said you don't ever pull the principal out, right? You don't take any of that emergency fund. You leave that in there, and you're buying the paid up additions. If I buy $100 this month because my payment's $100, and then next month I pay another $100, and next month I pay another $100, then I've got $300 in my account. And then I want to take a loan, I've still got $300 in my account. And I pay off a debt, I've still got $300 in my account. And next month when it compounds and the dividend hits it, now I've got more than $300 in my account. And I didn't do anything for that. It just happened. Okay. So how does the plan work when you're paying off debt? Well, here's how it works. So I told you that you don't ever take principal. You don't pull money out of your plan like that. The only time you're ever going to take money out of this plan, and this is why it's all going to be tax exempt as long as you execute the plan properly, you're either taking money out as a loan, and there's never tax on a loan, or you're taking money out from the principal, which means there's only time there's going to be tax on the principal is when your basis is lower than the amount of money you're pulling out. So is this bank going to grow faster than the money that you're putting in there? At some point, yes, but not in the beginning. So is it possible for you to pull out more principal? No, it's not. Could you pull out more than your paid up addition value is? No, you can't. I told you this thing, the dividends that these things create can be used to pay off your loans automatically for you. Maybe I didn't say that. If I didn't, hey, the loans that you take out can be automatically paid off for you through the dividend. That's great, right? Does that mean you have to pay your loan back? That means you don't have to pay your loan back. Well, how can I borrow money and not pay a loan back? Well, because you've collateralized the loan. So when you bought your house was collateral for your loan. And if you die, then your estate is going to either have to sell the house or pay the house off before you're going to get the title of the deed. There's no difference here. Your paid up additions secure the loans. The paid up additions you can borrow up to 95% of the paid up addition value of your account, which grows every month, whether you're contributing or not, because of the compound interest and the dividend, right? It's brilliant. I think it's brilliant. So how do you pay? Here's how you pay. You take a loan. You take a loan from your DFL bank. So did you touch the principal? No. Did you touch the paid up additions that are in there? No. You took a loan. You used the paid up additions as collateral against the loan that you take. And oh, by the way, through compound interest and dividend, you're being paid more interest than they're charging you for the loan. So your plan still makes money even if you got a loan out against it. Still works because you're never able to touch all the money that's in there. You're never able to loan 100% of what your loan capacity is. So you take that carrier loan and then you send notice to your bank, either in the form of a check or in the form of like a bill pay, and you tell the bank, go ahead and please pay my debt. And so the bank does what you tell it to do. It pays your debt, and now the money that they were paid becomes their money. Where's your money? Your money is still sitting there in the middle in your DFL bank because you didn't use your bank. You didn't use your money to pay the loan. You used the carrier's money to pay the loan. So what happened? The carrier's money became their money. Your money is still sitting in the bank earning the guaranteed 4% plus the dividend. It's not magic, folks. It's just math, and it works. So how does it work in real life? So I'm going to show you two examples. So here's a family I worked with back in October. This is your standard family. They've got a lot of debts, some student loans. They've got a couple of residences because this is a blended family. Both the husband and the wife were married previously, so there's 2 residences down there. They've got some tax issues. The gentleman here, he's actually an over-the-road truck driver. So he's got taxes because he's a 1099, and he's got taxes that he carries through every year and pays them off over the course of a year. So this is what their current situation was back in October when we executed this plan for them. So they have a total amount of debt, get this, $767,000. $584 is the principal amount of their debt. What does that mean? That means if they have the ability to go stroke a check for $585,000 out of their checking account right now, they could be completely debt-free tomorrow, but they don't. They don't have the ability to do that. They don't have the cash to do that. So what do? They do what all of us Americans are taught to do. We finance it. And so they finance their debt. And so when it comes down to it, over time, once they pay off all their debt, they will have paid in, you can see that number right there, $182,000 of additional interest. So they added $182,000 to their debt. This is what we did for them. 7.8 years. Yep, that falls into that 9 years or less rate. So we cut out over 32 years of time for them to get debt free. We eliminated $70,000 plus in interest. But that's not the kicker. Remember, this plan has 3 phases. Maximization, right here, paying off the debt. Accumulation, where we're making sure we're building the cash value of the plan as quickly as possible and as large as possible. And then distribution. So here's what this is what it would have cost this family not to do this plan. If they had continued on their current trend, their current track, paid off their debt in 40 years, the whole 9 yards, In 40 years, they would be completely debt-free with 100% equity in 2 houses. With our plan, they're completely debt-free with 100% equity in 2 houses and $4.8 million sitting in their bank. That's the effect of compound interest, folks. Einstein said it. There's nothing more powerful in the world than the effect of compound interest. Not only that, it created a legacy for their family. Why? See that second number, 5.96 million? That's the amount of the life insurance policy that's paid up, fully paid up. They never have to pay another penny on it. It's there. It'll be there forever. It'll grow forever. How does it work? Here's how it worked. So this family, they're in their 30s. They make good money. They got a lot of debt. They wanted to be out of debt fast. We got them out of debt in 7.8 years. So every one of those yellow bars that you see, everything that's highlighted, that's a year where we paid off at least one of their debts. Something I wanted you to show you, because we're going to go into this in just a few minutes. See year 4? Year 4, there wasn't enough money to pay off the next debt, which was $96,000. That was one of their, I believe that was one of their houses. So what happened is the money just built up. So the next year they pulled 96,000. At the end of the year, they still got 61. They paid off another debt. Next year they paid off another debt. And now we get to this point where the amount of money that we owe on our last remaining debt has come down just through the process of paying for it. And the amount of cash in our plan has come up so that where they cross, we have the opportunity and ability to pull the trigger, take that loan, in this case for $117,000, pay off the balance of that house. And oh, by the way, at the end of the year, they still had $75,000 sitting in their bank earning an interest. And now that's the end of the maximization phase. Now we're in the accumulation phase. This is where we're retooled all that money. So all that debt that they had, $700,000 and change, right? We paid it all off in 7.8 years. And by year 10, the loans that we had for that are also already paid off. They're paid off through a combination of continuing to make our payments on the plan, and in this case, the dividends that are coming in. But look at this. This gentleman told me he wanted to retire at age 75. Okay, so we go to age 75, he's retired. Age 76, he didn't make a single payment, right? 0 payments. But at age 75, when he made his last payments, we made only a $10,000 payment that year. And we were at $4.85 million. So let's take off that 10,000. So we're at $4.84 million. The very next year, we've grown to $5.05 million. What does that mean? That means we grew $190,000 that year just through interest and dividend. And it continues to grow that way. We never have to make a payment again on this plan. So this gentleman, if he wants, at age 76, or even earlier really, he could take $190,000 a year tax-free income every year for the rest of his life, and he would still have over $5.05 million in his account. That would be legacy, generational wealth, and he's got a life insurance policy that's fully paid up worth $3.3 million. It's insane. It's crazy, and it's real. That's the crazy thing. So let me show you how it works for another group. So that's how it works for a family. Let's talk about someone who doesn't really have that much debt. Let's talk about a a woman that I worked with, 23-year-old. She's in a master's program at in California, at UC Berkeley, I believe. And this is it. She doesn't own a house. She has a lot of student debt, but that's about it. So her debt, with student debt, she owes $91,000 if she could stroke a check today. But because of the nature of student debt and how vicious student debt is, she actually owes $177,000 if she's going to be paying on the payment plans that are currently set for her. And it's going to take her 40 years. So she'll be retired at 63 with 0 debt and nothing to pay for, nothing to show for it. So our plan is a little bit different. We're going to pay off that $91,000 in debt, which, oh, by the way, is even more than her actual principal amount. It's crazy. We're going to pay all that off quickly. How quick? Well, in her case, 9.7 years. Now, why is it taking her longer? Because she's not paying as much into the plan, and the snowball that she has is not going to be as large. She's a 23-year-old. She works as a waitress. She doesn't make a lot of money. She can't afford a $2,000 a month plan. She can afford a $350 a month plan, which is what this one is. Okay. So she's got some hospital bills, vet bill, car loan, and then the rest of this is all student loan stuff. So what do we do for 9.7 years? That's great. So she gets out of debt in 9.7 years. But what else happens? This is what happens. In 40 years, when she turns 63, she'll have $600,000 in there sitting, waiting for her. She told me she wanted to retire at age 65. Oh, by the way, there's also another $400,000 in life insurance that she can leave to her family. Is she ever going to have to buy another life insurance policy? Is she ever going to have to take out a 401k? Would she be a fool to take out a 401k rather than put the money in here? I'll let you answer those on your own time. Here we go. So this is what her plan actually looked like. Every year she's paying, almost every year she's paying something off. But here's the coolest thing. She said she would retire at 65. I got her retired at 55. At 55, she's got over $400,000 sitting in her account. It's growing at $22,000 a year. She's not making any premium payments whatsoever, which means she's got a $22,000 a year tax-free income starting at age 56 years old, which is the equivalent of about a $36,000 a year taxed income. So basically, I just gave her a job, right? And then it grows and grows and grows and grows. And if she makes it to 76, which I would bet that she is and will, there'll be over $1 million in that account. One of the things I want to point out here, see the second column, the savings column? Our system is unable to illustrate a dividend. Also, because of the nature of IRS tax code 7702, we can't put more money in here than the plan can hold. So what our system does is when we get to that threshold where we can't put any more money in here, we put it into a savings account. So that savings account is illustrated with a 2% return. Good luck finding a savings account that's going to pay you 2%. Moreover, why in the world would you put it into a savings account that pays 2% when you could just simply start another bank that pays 4% plus a dividend? So realistically, the plan will work better than we're illustrating here, because we're not going to earn just 2%. We're going to earn 4% plus a dividend, because we're going to start a second bank on somebody. All right, so that's the end of this little presentation. I'm going to stop for a second. I want to talk next about one of the things I've talked about this a couple of times. Hold on one second. All right. I've talked about this a couple of times on a couple other of these presentations, and it's just something we call mortgage chunking. But I want to talk about not just mortgage chunking, but chunking in general. So chunking can be done on anything. It doesn't have to be just a mortgage. So if you've got a credit card with like $15,000 balance, and you get to the point where you need to pull some cash out, do it. Pull the cash out. Throw it at that credit card. Chunk the mortgage. The effect will be the same. The effect over time on chunking is that you eliminate a significant portion of principal early on in the process. And by eliminating that principal early on in the process, it creates an environment where they're going to be able to apply less of that compound interest over time. So whenever you get an opportunity to chunk, do it. And it doesn't have to be just mortgages. But let me talk about mortgages for just a second. So this is a mortgage chunking, a little mortgage chunking piece that we got for you guys. All right, so when we talk about mortgage chunking, I'm going to use that family that we used earlier with the two houses and the large amount of debt, and that. So this is the family that I'm using to illustrate mortgage chunking. If you'll notice here, their personal residence is a $215,000 mortgage. Okay. If you go a little bit further, here's how I can demonstrate chunking. Remember how I told you to pay attention to that $91,000? They could have chunked $91,000 of one of their debts in that year. The system that we use, the software, does not show chunking, okay? What happens if I throw $91,000 of my mortgage cash against the principal? I destroy my mortgage. I destroy the amount of interest they're going to be able to charge me over time. And I really, really anger my bank. And I don't care. They can go pound sand. Thank you for giving me the loan. I'm never going to need you again after I get my DFL campaign running. I'm going to go ahead and pay this off as quickly as possible because I want to keep my money, right? So chunking, how does it work? Let's making some assumptions here, right? So I showed you that family had a $215,000 mortgage. So we're assuming we're using that family as the example, right? So it's a 30-year mortgage. We're going to assume some other things. In that scenario that I just showed you, the majority, and this is the case for most people that we do these on, the majority of their smaller debts are paid off in about 2.3 years. Moreover, in 2.3 years, the debt snowball is started and it's rolling and you can't stop it. It's growing too fast. You couldn't stop it if you wanted to, right? And what does that mean? That means through the course of paying off those little tiny mortgages over time, we're buying about an additional $10,000 a year of PUA. That means we're increasing our loan capacity each year by about $10,000. That's awesome. What does that mean? That means I can make a mortgage chunk every year by $10,000. What happens if I make a mortgage chunk every year of $10,000 on my mortgage? Let's find out. So here's that company, that family we just showed you. This is the actual amortization schedule from their plan. Okay, this is a $215,000 mortgage at the interest rate that they were quoted, which by the way was 3.5%. Anybody have any idea how much your first interest payment is? Actually, 74.71%. So how are they able to tell you that it's a 3.5% mortgage? Because in year 30, you're going to have at least one payment where the actual interest that you're paying is only 3.5%. That's the dirty little secret about the mortgage lending industry. So what we do here, if you notice, each one of these payments from May to June, you're actually switching. You're paying one less, you're making the same mortgage payment, but you're paying one less dollar in interest, and they're crediting one more dollar in principal. And then the next year is the same. The next year goes up $2, right? What's happening here? As we go through our amortization schedule, every time we make a payment, the payment becomes more and more efficient paying the principal of our loan. So what do I tell you that we were doing with Debt Free Life? We are putting you in a situation where we're making the most efficient use of your dollars, right? So mortgage chunking is just another tool. It's just another tool that we do that's part of the program, part of the plan. If you want to execute it, you don't have to. I have found that mortgage chunking will increase the efficiency of a DFL plan by 10.6%. So if you were going to get out of debt in 7.9 years, then you're going to get out of debt in 7.1 years using a mortgage chunking routine. Okay, so here's how mortgage chunking works. Pay attention to this one. So in May of 2020, we owed $214,712. Over time, 2.3 years, right? Over 2.3 years, we paid down the majority of our debts, and we got to the point where there's $10,000 sitting in our account. So May 2023 is 2.3 years. Okay, so now just through the course of making our regular mortgage payments, we've paid our mortgage down to $203,000. That's what we owe. And now the bank is going to get an unwelcome payment of $10,000 that's going to be immediately applied to the principal of my loan. And I'm going to adjust how much I owe from $203,000 to $193,000. What did I just do? I made a single $10,000 payment, principal only, to my mortgage company. What was the effect? The effect was I escalated my mortgage plan to year 2025. So in that one $10,000 payment, I made it through 28 months. I escalated my mortgage through 28 months of premium payments. What else did I do? I eliminated 28 months of interest payments. How much is that? It's around $22,000. So by my one $10,000 premium payment, I eliminated $22,000 of interest and $10,000 of premium principal. Guys get it? So what else did I do? Remember that earlier I was showing you how we went from $330 to $331 of principal that we were paying. Now look what we're paying. Every single payment after this payment from here on out, I'm now paying $372. I'm making the same mortgage payment, but now each payment is more efficient because now more of my premium payment is being applied to principal because I've escalated myself through the amortization schedule. Okay, so this is what mortgage chunking does. It has the same effect on credit card chunking or personal loan chunking, depending on the terms of the loan. If there's a prepayment penalty, then it won't work. Then you don't chunk that one. You chunk something else. Okay, so that's the end of the mortgage chunking presentation, and this is where we're at. 6:34. I did it, George. 30 minutes. It's exactly where I wanted to be. You guys are all here. Somebody take notes. Fantastic. Hello, Mr. McRae. Can't hear you, but hi. So what I'm going to do now is I'm going to open it up for questions. If you have any questions, go ahead and ask. I'm going to look. There's nothing in the chat box. That makes this easy. So anybody have any questions? Awesome. Stu, let's talk about your guy for just a second, because you had an interesting case, and that's something that as DFL agents we should also look at. So Stu, earlier today we were talking about your fella, and what we were talking about was that you had someone who had a chunk of change they were looking to invest, but they didn't have any debt. Right. So, we were talking about, will a DFL campaign work for them? And one of the things we came to was absolutely it will. Why? Because he's already through the maximization phase. He's already at the accumulation part. Exactly. So will it work as well for him as other people? No, because he doesn't have any snowball. But we also talked about there's a specific horizon for him, right? He's got about 7 years left. Yep. So you can structure these plans with a 7-year pay-in. And here's the cool thing. If you build up that term rider large enough, you can throw in a lot of extra cash, okay? That's 100% PUA purchase. And when you do that, especially if you execute that PUA purchase like this gentleman, because he's got the money now, he doesn't have to wait. He's not going to make premium payments. You're going to structure that one with an annual payment, one payment per year. Right? And you're going to maximize the payment on the first time, and then you're going to maximize the PUA purchase for the year, and you're not making any more payments the rest of the year. So what did that do? So that's where that 4% compound interest, because it's compounded monthly, the return will be greater than 4%, even without considering the whole dividend piece here. What's going to happen is you're probably going to be closer to about a 6% return with him, because you're maximizing the PUA. And the way we talked about it, by having that large term policy, we made a room, there's a what the payment's going to be, but then we also made room where you could put an extra PUA that year. I think the number we were looking at was like about $10,000 extra or $8,000 or something like that. Yeah, it's like double. Yep. So because of his situation where he's got that large chunk of change and he wanted to be able to put it in play early, we're going to do it. We're going to do an annual premium for him. He's going to overload it year one, put his maximum in year one, and the rest of the money that he's got that he wants to throw in is going to have to wait. And then year two, you maximize it again on the first day of the anniversary of the second year, and then he's got to wait. Year three, do the same thing. So in 3 years, all his money gets in. There'll be a little bit left over from how much he wanted to put in there, and that's where you have to make the decision. You're going to have to continue making the payments for another 4 years, right? Because we were going to schedule this for a 7-year plan. Right. So in that remaining 4 years, he's going to have to pay whatever the minimum is. He doesn't have to pay the PUAs. He's just got to pay the minimum. He's got to pay $100 a year on PUA. That's it. Okay. So he pays the minimum and then is done with it. And there was enough money left over, I think, to pay 2 years like that. So that means you're at year 5. You got 2 years left. What do you do in those last 2 years? Take a loan. Pull $1,200 out and then pay the thing. Right? And then that's it. And so basically his plan becomes completely self-funded almost immediately. Right? And then in 10 years, that whole amount of money, because of the compound effect and the dividend and all that stuff, it should almost double in value in 10 years. Yep. With zero risk and zero tax.
This was all my hunch, and you confirmed it.
Yep.
Scott?
So, yes.
Oh, okay.
Hey, Linda.
Sorry. Hey, I had 2 questions. One of them kind of a response, and I've gotten some consistent feedback from when I did my first talking, or just like setting up the initial meeting. And I had 2 people who were definitely capable of putting in $500, $1,000 a month, and so debt-free life seemed to make sense. And they were also eager to pay off their mortgage. They didn't have any other debts though. They were all no credit card, nothing else. So for them, they both also decided, I'll just, I'll just do the same thing. I know I won't quite get all the other benefits, but just pay off their mortgage quicker. And it's true, right? If they just wanted to get out of debt, right, then just paying off the mortgage directly is the fastest way. Right? Or
maybe
no?
Fastest, but you're not going to get
anything else.
Yeah. And the cash value at the end is going to be, DFL is going to be significantly higher.
So what would you say, so they don't get the death benefit, and must have done something wrong, because they were both like, I don't want to pay for extra insurance. It made it seem like they're paying more to be able to do the same thing if they're not
doing the same thing.
So
at the
the
end,
death benefit and the
and they're-
compound and everything,
Right.
something just didn't click. They
Even-
didn't see the, and it
Even
was
take
like,
the death benefit out of the equation. Make the death benefit irrelevant. Say, look, don't even pay attention to the death benefit. Let's assume your death benefit is 0. We don't care about the death benefit. Here's what I care about. Your mortgage your way is going to get paid off in 9 years, and you'll have 100% equity in your house. The mortgage our way is going to be paid off in 11 years, and you'll have 100% equity in your house. And you'll have $150,000 sitting in your bank earning 4% interest plus a dividend every year for the rest of your life.
okay.
It's not about the death benefit. It's not.
No, and I think it just
And you can't
maybe
make it about the death
emphasized that
benefit.
too much. Yeah. So versus not even, because they didn't even want to see the numbers. We were setting appointments for the DFL thing, and they were just like, I've been thinking about it. So clearly something didn't work.
They haven't been thinking about it. They don't understand it. And,
Right.
the thing that, if their concern is they want to get out of debt, why?
So yeah, for basically both of them wanted to have more for retirement.
Right. So you dig deeper. Why is it that you
Mhm.
want to be out of debt? So I can have more money for retirement. Okay, great. So you can have more money for retirement. You can be out of debt. You can have 100% equity. And oh, by the way, you can't defeat this. You put money into your 401k. How long is it going to last? You put money into this, you can pull money from this every year for the rest of your life. You will not be able to defeat this thing. It will continue to grow even after you stop contributing. It's a
Okay.
no-brainer.
Yeah.
So,
Okay.
so
All
Linda,
right. So that's good. Mm-hmm.
So Linda, a couple weeks ago, I was talking with Scott on this call about my son, the engineer, who basically, I spent more time telling him about this and convincing him to do this to get himself out of student debt. The final argument for him was, okay, if we follow your plan, you're going to get out of debt by this time period. Follow your plan, you're going to get this time period. The difference is you're going to have nothing left in your savings versus you're going to have this left. And I said, it's up to you. Which one makes more sense? And of course, as an engineer, he said, of course, I want the money in the savings. But sometimes you just got to net it down to take all the other variables away and say, you're getting out of debt in 10 years, that's great. Or you're getting out of debt in 10 years, that's great. You're getting out of debt with nothing to fall back on if you need to go into debt again. You're getting out of debt with, in his case, it was only $15,000, but it was $15,000. And he was happy for that. A lot of times I've run into that too. And you just got to go, like, you can't go wrong with either way, but which one's going to be better for you?
Okay. All right. That's helpful.
That you just got to get down to it.
Just net. Okay.
Just net it out.
Yeah. Got it.
So
I have one other question. Sorry.
Go ahead.
Just that point that you were talking about, Steve, with the one-time payment. So I have some people that have, they have some money. They say 5,000 that they want to put, quote, in this, and I didn't realize that you could do a one-time payment. So if you do that one-time payment, then you're locked into that one-time. You're saying you have to set it up so it is a one-time payment for the first 7 years, but you're only really locked into the insurance portion of it.
So Stu's case was a gentleman who wants to put in a specific amount of money. The problem is he's not going to be able to do it without meching unless he spreads it out over a couple of years. Okay. So we did not execute a one-time payment option for him. There is a one-time payment rider that you can add into these things where you can dump an extra $10,000. But here's what happens when you do that. There's a maximum amount of PUA that you can purchase every year, no matter what. There is an absolute maximum, and it's based on what your target premiums are. Okay. So that PUA the annual purchase, that one-time purchase, that's going to eat away some of that. So, so the way I like to do it with what I talked to Stu about was I want to make it so that it's a 3-year plan, a 3-year solution, and we're going to get most of that money in there over 3 years. And that way we're not going to worry about mech. And I don't have to make his premiums super high, because there's going to be a point where we've got all the money in the bank, but we don't want to make premium payments anymore. Right. But we're going to have to. We have to keep the policy alive, and then keep the policy alive, you have to pay the minimum term, the minimum whole life, and at least $100 a year on the PUA rider. So as long as you're doing that, the policy stays alive, and then you get to that 7-year window, and then you can stop. But you have to get to that 7-year window.
Okay.
I don't know if that helps you.
No, that helps, because then I have, another person or, another potential, just to have a chunk of, here, I want to put in, I have this chunk of money that I can put into it, but I know I can't just, it's like, don't want to do an annuity. So, to do this kind of DFL. And then there's some other product, I think, that Scott had mentioned, where it was, you can make more, it doesn't have to be locked in. So that was the thing that scared him. He didn't want to be locked in, So,
and the other thing is this, remember, you structure these things and you get the target, and that includes the FPUA rider and all that stuff. They don't have to pay the FPUA rider. So that's where when I'm structuring these things for people, I'm always telling them, look, I don't know how much you're going to want to put in this. I know where we're going to start, where your zero cost is, but I also know you've got these other things. So let's do this. Let's go ahead and write this thing at the highest level, because that way we'll get you underwritten for that. You can always come back, but you can't go beyond that when we start. And so that's how I'm always
build in some wiggle room.
And I build in the FPUA. And that way, okay, so do we need to pull back? And that's where, okay, they're ready to issue. They've underwritten for X. And then we say, okay, look, thank you. We're not going to take X. We want to take slightly less. And they'll say yes every time to taking less. But that you can't go, if you go higher, then you got to go through underwriting again. It's a pain in the ass.
Right, right. Okay, got it.
That's my suggestion on that. Shoot high and then be able to be pulled back and give yourself control.
Okay, great. Thank you.
Yep.
So Scott.
Yes, sir.
Question for you. We're all talking about these lump sums. I've got a case where a gentleman's got 4 adult kids, and all over the age of 18, and he's got $50,000 that he'd like to kind of spread across them, basically help them get started in their own family banks. 12-5, 12-5, 12-5, 12-5, and roll it in, or is this an opportunity? It kind of explain that daisy chaining again to me a little bit, because I didn't quite follow all that.
Okay, so daisy chaining is when you get to the end of a bank before the bank's going to be completely executed, and you take a large loan from it.
Okay.
And then you use that large loan to fund a new bank on a younger generation. And that way you're transferring the wealth from generation to generation to generation without a taxable event. So
this gentleman doesn't want to do that.
Okay.
I mean, he's got a 50 grand that he wants to, is there an analogy?
Yep. To a TAMRA 7-pay solution.
7-pay solution.
To TAMRA 7-pay. And for you at 50,000 spread over 4 people, the annual premium is going to be $1,785.71.
Okay.
And do it on a 68-32 split to maximize the PUA.
What would happen? Did you say 62-38 or 68?
68% PUA, 32% whole life term.
Gotcha. Now, what would happen what would stop him from setting up one and then taking a loan from that one and setting up another one, and taking a loan from that one and setting up that?
Nothing, except you have to pull the money out long enough to season. Because there's that question, did you take money from another policy to fund this policy? So you have to be able to answer that no. So you have to let the money season.
What is that, Scott? Is it 6 months?
I think it's 3.
3 months.
Okay. Now there's a question from Nancy, and Nancy apologizes. The microphone on her laptop is not working. Just wanted to make sure that we were clear on this, but she's trying to understand how to get a debt-free life program working. And if I understand her question, and Nancy, go ahead and text me if I get this wrong, is it's more than just taking the minimum payments from all the debts that you're making right now. As we go through a process to identify money that's not being used efficiently, maybe they're making overpayments on that, or maybe they're putting money into a 401k that's not getting matched, and we're taking that extra money, and that's what we're using to begin the debt-free life plan, as that extra money that was either overpayment to existing debts, money going into a 401k that wasn't efficiently used, or just extra money in your budget that was sitting in a checking account every month. As that grows, that's when we begin the debt snowball by retiring those other debts and kind of bringing them into the program. So Nancy, if you can, text me real quick. Did I accurately ask that question the way you wanted to ask it?
You answered it, Tom.
I know.
It's perfect.
But, okay. So just making sure. Okay, good. Got the thumbs up from her. Okay. Thanks for that. And Scott, I know we're down to the 10-minute mark before
Yep.
we've got another
We got to
training
get off
call.
in 5.
Okay.
Because
So
we have annuity training next with Jamie McRae.
anybody have any other questions? I mean, these have been great questions you guys have been asking, especially Linda's and Stu's with talking about rolling larger amounts of money over. Any other questions? David?
Yes, quick question. You mentioned right at the beginning, you asked, how confident are you about your retirement? In conversations that we're having about home protection, flags that go up, they realize this person's a good candidate for debt-free life.
Go ahead, Tom.
Okay, so if I understand your question is when I'm doing mortgage protection, what makes me say I really need to talk about this person about debt-free life?
That's right.
Okay, so first of all, you got to do the mortgage protection first, because this is a long-term plan to get them out of debt, and we got to make sure that we get them protected for something that happens tomorrow. Okay. And you really want to dive right into debt-free life right then and there with them, but you gotta sit there and focus on what we're doing and then come back around to this. Now, with that said, anytime I get the opportunity to do a detailed financial analysis, a little bit more detailed than what they did in the Thursday training today, and I hope you got a chance to go to the Thursday training today because it was awesome about doing a financial fire drill. But whenever I see anybody putting any extra money towards any debt whatsoever, period, they are a good candidate for this, because they're already overpaying they're already overpaying that money is being used very inefficiently, like Scott showed earlier. You're giving it away to them. You're losing control of it. It's not working for you. I've time and time again sat with families that are putting a couple $100 towards their debt. And this makes them an ideal candidate right away for debt-free life. Get the mortgage protection done, and then plant the seeds for the debt-free life plan right after that. That's the biggest red flag right there. Okay. Scott, what do you want to add to that?
You got it, man. One other thing, the mortgage protection solutions that we use, typically they're going to incorporate a better suite or a more robust suite of living benefits. Yep. The living benefits associated with the DFL plans are usually, they're inferior. They're not bad, but they're just not as good as what you're going to get with a term solution that's built for mortgage protection.
Okay. Now, one thing I have done is if I'm talking to somebody with a 30-year loan and they're really healthy, I have absolutely talked to them about getting mortgage protection for 20 years, because I know right off the bat we can offer them advice of doing a biweekly, switching to a biweekly payment plan, which means that instead of making 12 payments that year, they're making the equivalent of 14 payments that year, and that's going to knock 7 years off their mortgage right then and there. And this is something that Rossin Tugbert had talked about in one of his in talking with him in the last week or so. If you're not familiar with it, banks are offering the opportunity to pay every other week, right, which means you're putting in an extra payment in over time. You're making a half payment every other week. Right. And the long-term effect of that on a 30-year mortgage is to knock 7 years off right there. So I always ask people, how long you plan to be in the house? Right. How long you plan to have this mortgage? Are you actively looking at paying it down? And I'm looking for these clues. So all of a sudden, a 30-year mortgage protection plan doesn't make sense for them if they know they want to pay it off sooner. We can comfortably say 20 years, and then start to work on the debt-free life after that's in place.
Okay. All right, we have come to that time. Thank you, everybody, for coming. Hopefully, you got something out of this. Oh wait, there's one more question. Oh, there you go, Linda. All right, so for those of you that are joining us,
thank you,
Scott. Hey, listen, thanks so much for your time again. Really appreciate it.
My pleasure. And Tom's on deck next week.
That's just a rumor I've heard.
Awesome.
I'm not
very good.
Yeah. Yay.
Yay. Yay,
I will do the best I can to fill your shoes, which are rather large. You got it,
man. It's okay. It's all good. All right. So I'll see everybody on the next call that's going to the annuity call. Talk to you later.
Okay,
Bye-bye.
Bye-bye.
Bye. Thanks, Scott.